Ladies and gentlemen, welcome to the English Daily Book Summary YouTube channel. In order to not stop learning, listen to an English book summary every day for free.
John C. Bogle. Common Sense on Mutual Funds. New Imperatives for the Intelligent Investor. Investing doesn't have to be complicated. The most effective strategies rely on common sense and sound reasoning, not market speculation or expensive fund managers. Yet, the financial industry is full of distractions, high fees, aggressive marketing, and short-term thinking that work against your best interests. Too many investors make decisions based on past performance, industry hype, or the illusion of expert stock picking, when in reality, the best approach is simple: low-cost, long-term investing in a diversified portfolio. The mutual fund industry, originally designed to help everyday investors, has shifted away from its core purpose. Instead of prioritizing trust and long-term returns, many fund companies focus on gathering assets and increasing their own profits. Understanding these industry practices is essential if you want to protect your investments and maximize your returns. In this blink, you'll learn why past performance is unreliable, how high fees eat away at your returns, and why most fund managers fail to beat the market. You'll also see how time, cost efficiency, and discipline are the most powerful tools you have for building long-term wealth. The information discussed in this blink was first published in 2009, so keep in mind that the market and investing approaches may have changed since then. There are no guarantees when it comes to investing, but this blink still offers solid advice on the essentials. Long-term investing is like tending a garden. Patience yields the best results. Well-tended gardens thrive not because gardeners constantly dig up plants and move them, but because they let time and nature do the work. Investing follows the same principle. Trying to predict short-term market moves is a losing game, while a steady, low-cost, long-term strategy is the best way to build wealth. Many investors believe they can outsmart the market by timing their trades, selling when they think prices are high and buying back when they drop. But history shows that this strategy rarely works. Market timing is not only difficult, but often counterproductive. Those who try to jump in and out of the market tend to sell during downturns, missing the rallies that follow. In the long run, most investors who attempt market timing end up underperforming those who simply stay invested. Instead of trying to predict the market, focus on how you allocate your investments. The balance between stocks and bonds in your portfolio has a greater impact on long-term results than picking individual funds. Stocks provide long-term growth, but they come with short-term ups and downs. Bonds help stabilize your portfolio and provide income. Your ideal mix depends on your financial goals, risk tolerance, and time horizon. A simple rule of thumb is to keep your bond allocation roughly equal to your age. So if you're 40, you might hold 40% in bonds and 60% in stocks. This ensures that your portfolio gradually becomes more stable as you get older. Keeping things simple is the key to success. Many investors assume they need complex strategies, frequent trades, or expensive fund managers to get ahead. The truth is, most actively managed funds fail to beat the market after fees. Low-cost index funds, which track the overall market, consistently outperform the majority of actively managed funds over time. On top of that, frequent trading racks up unnecessary costs, including fees, taxes, and losses from poorly timed moves. The most effective strategy is also the easiest. Invest in a well-diversified, low-cost portfolio, leave it alone, and let time do the work. Stay invested through market fluctuations, rebalance when needed, and avoid the temptation to chase trends. The market rewards patience, and those who stay the course will almost always come out ahead. Most investment choices are a waste of your money. The investment world is full of choices, but most of them do more harm than good. The mutual fund industry thrives on marketing gimmicks, high fees, and complex products designed to extract money from investors rather than build their wealth. While fund managers claim to offer expert stock selection, the truth is that most actively managed funds fail to outperform the market, and those that do rarely maintain their edge. A staggering 85% of actively managed funds underperform the market over the long term. Fund companies aggressively promote funds with strong past returns, but studies show that past performance is an unreliable indicator of future success. Many funds that appear to be winners for a few years ultimately revert to average or below average returns. Worse, over 30% of mutual funds disappear within 20 years, often because of poor performance. The funds that survive often merge with others, hiding their real track record from investors. One of the biggest hidden costs in active management is excessive trading. Many fund managers frequently buy and sell stocks in an attempt to outperform the market, but high turnover leads to higher transaction costs that eat into returns. Funds with turnover rates above 100%, meaning they replace their entire portfolio within a year, incur significant trading expenses, even if investors don't see them directly. Bond funds are another area where investors need to be cautious. Not all bonds are the same. Many high-yield junk bond funds promise higher returns but carry significant risks. Some bond funds mix in lower quality securities to boost yields while charging higher fees. Investors seeking stability should focus on high-quality US Treasury or corporate bond funds with low costs, rather than chasing high-yield options. International funds are often marketed as essential for diversification, but global markets have become increasingly correlated. Many US investors already gain international exposure through large domestic companies with global operations. Additionally, international funds tend to have higher fees, currency risks, and geopolitical uncertainties that reduce their appeal. The mutual fund industry is built to maximize its own profits, not yours. The best way to protect yourself is to avoid expensive, actively managed funds and unnecessary complexity. Instead, stick with low-cost index funds and high-quality bonds. If an investment sounds exciting, it's probably costly and unnecessary. Keep it simple, minimize expenses, and focus on long-term wealth building. Long-term investment performance is predictable if you follow the right strategy. Most people think investing is about skill, picking the right stocks and funds to get ahead, but history tells a different story. Over time, stock market returns and mutual fund performance revert to the mean. Today's top-performing funds are unlikely to stay there, and high-flying stocks often come crashing down. A common mistake is focusing too much on relative performance, comparing returns to an index or other funds. What really matters is absolute return, how much money you actually make. Investors assume past performance predicts future success, but market leaders change. Instead of trying to beat a benchmark, the goal should be consistent, efficient wealth growth. Size also affects fund performance. Some of the best-performing funds in history saw their returns drop as they grew too large. The Fidelity Magellan Fund is a prime example. During Peter Lynch's tenure, from 1977 to 1990, Magellan delivered an extraordinary 29% annual return, significantly outpacing the market. However, as assets ballooned, eventually reaching $75 billion, the fund's agility diminished. Its sheer size limited investment opportunities, forcing it to take larger positions in fewer stocks, reducing its ability to maneuver. Trading costs increased, and market impact became a greater challenge. These factors made it difficult for Magellan to maintain its previous outperformance. Large funds face these same structural limitations, struggling to find enough high-return opportunities while being weighed down by their own bulk. Tax efficiency is another overlooked factor in long-term investing. High-turnover funds generate taxable capital gains, eating away at returns. Over 15 years, the average equity mutual fund earned 13.6% per year, but after taxes, that dropped to 10.8%. A 2.8% annual tax loss. Meanwhile, fund turnover rose from 30% to 90%, further reducing tax efficiency. To keep more of your money, use low turnover funds, tax-efficient strategies, and tax-advantaged accounts. Index funds not only outperform 94% of actively managed funds before taxes, but 97% after taxes. The most powerful force in investing is time. The longer you stay invested, the greater the impact of compounding. A $10,000 investment in the stock market in 1982 grew to $117,000 by 2009, assuming no costs or taxes. Short-term speculation increases costs, taxes, and risk, while taking away the key advantage of time. The evidence is clear. Successful investing isn't about market timing or chasing hot funds. It's about minimizing costs, reducing taxes, and staying invested. Stay disciplined, ignore the noise, and let time do the work. The hidden costs of mutual funds are draining your returns. Most investors assume that mutual funds exist to serve their shareholders. In reality, the industry has shifted from a management-driven model to a marketing-driven one, prioritizing sales and asset growth over long-term investor returns. Instead of focusing on investment stewardship, many fund companies are designed to maximize their own profits at the expense of the investors they claim to serve. Mutual funds were originally built on principles of trusteeship, professional competence, and long-term discipline. But today, asset gathering has replaced sound management as the primary goal. The average mutual fund now turns over 85% of its portfolio annually, meaning most stocks are held for barely a year. This constant trading generates high fees and taxes for investors while benefiting fund managers through commissions and transaction costs. Marketing has become the industry's dominant force, shaping not what investors need, but what sells best. Fund companies spend millions advertising past performance, despite overwhelming evidence that past success is rarely repeated. Instead of encouraging long-term investing, marketing tactics drive chasing trends, switching funds, and increasing speculative behavior, all of which lead to lower returns. Worse, these advertising costs are covered by fund shareholders, meaning you're indirectly paying for your own manipulation. Technology has also played a role in shifting mutual funds away from their intended purpose. While it has made investing more accessible, it has also increased short-term trading and speculation. The rise of derivatives and complex financial instruments has made markets more volatile, benefiting fund companies and trading firms while leaving ordinary investors exposed to greater risk. More data is available than ever, but most investors act on short-term noise rather than fundamentals, hurting their long-term gains. Even the people meant to protect investors, fund directors, have failed in their responsibilities. Unlike corporate boards, which are accountable to shareholders, mutual fund boards often rubber-stamp decisions that benefit fund managers over investors. Many directors approve higher fees and underperforming fund managers without challenge, showing clear conflicts of interest. Some even receive compensation far above what directors of major corporations earn, raising serious questions about their independence. The biggest problem is the way mutual funds are structured. Investors own shares in the funds, but do not own the management companies that control them. This separation means that fund managers can charge excessive fees and prioritize their own profits without true oversight. The only exception is Vanguard, which operates under a mutual ownership model, ensuring that its interests are aligned with those of its investors. If you want to protect your investments, avoid high-cost, actively managed funds that engage in excessive trading and aggressive marketing. Choose funds with low fees, a focus on long-term performance, and a structure that serves investors rather than fund managers. Strong businesses and smart investing are built on principles, not profits. Most financial firms focus on numbers, growth, market share, assets under management. But investing isn't just about money, it's about people. The best financial institutions recognize that their job isn't simply to maximize revenue, but to serve their investors with integrity and long-term vision. A firm that puts shareholders first, eliminates unnecessary costs, and prioritizes trust over profits will always be the better choice for investors. Entrepreneurship plays a key role in shaping industries, especially when it challenges flawed systems. The mutual fund industry traditionally prioritized fund managers over investors, accepting excessive fees and short-term trading as standard practice. But breaking from the norm can create better outcomes. The investment management firm Vanguard's decision to eliminate broker sales commissions in 1977 was considered radical at the time. Yet it allowed the firm to lower costs and deliver better long-term returns for investors. True entrepreneurship in finance means making decisions that benefit investors, even when they go against conventional wisdom. Good leadership follows the same principle. A strong leader isn't just someone with intelligence or charisma, it's someone with a clear mission and the discipline to act in investors' best interests, even when it's unpopular. Many fund companies focus on marketing, asset gathering, and short-term performance, but real leadership means resisting these distractions and sticking to fundamental principles. Choosing index funds over active management was once viewed as a losing strategy, but it ultimately proved to be the best long-term approach for investors. While leadership sets the direction, a business ultimately succeeds based on how it treats people, both investors and employees. Too many financial firms see investors as sources of revenue rather than partners in wealth creation. The best firms recognize that trust is their most valuable asset. They avoid hidden fees, misleading marketing, and excessive executive perks, instead focusing on transparency and fair treatment. Again, Vanguard's commitment to fairness extends to its employees as well. Executives fly coach instead of first class and share the same dining halls as all other staff. A business that values its employees is far more likely to remain focused on delivering real value to its investors. If you want to invest wisely, choose firms that prioritize integrity over growth and long-term performance over short-term gains. Look for companies that charge low fees, resist unnecessary complexity, and operate with a structure that benefits investors rather than fund managers. A company that puts its investors first will always be the right place for your money. The main takeaway of this blink to common sense on mutual funds by John C. Bogle is that successful investing is about simplicity, discipline, and putting your long-term interests first. The financial industry is full of costly distractions, but you don't need to chase market trends or trust expensive fund managers to build wealth. By focusing on low-cost index funds, avoiding unnecessary fees, and staying invested over time, you can maximize your returns while minimizing risk. The best investment strategies are based on common sense and sound reasoning, and by applying them, you can secure your financial future with confidence. Okay, that's it for this blink. We hope you enjoyed it. If you can, please take the time to leave us a rating. We always appreciate your feedback. See you in the next blink.